What's going on, guys? This is Chandler Smith, and today I'm going to show you why you should never purchase a property in cash. As a matter of fact, I'm going to show you how I did purchase my first property in cash and how it ended up costing me over $157,000. So with that being said, let's jump into it. For those of you that don't know me, my name is Chandler Smith, and I currently own 71 doors of rental real estate. I have a 32-plex that's under contract, and so I'm hoping in the next month that I will pass 100 doors of rental real estate. And the reason that I share that with you is I've had the opportunity to do a lot of deals in the last 6+ years, and the first deal that I ever did, I actually did in cash. It was purchasing this condo for $72,000. And what ended up happening is I did get a pretty decent return on this property. I didn't end up losing money in the deal. As a matter of fact, some would even say that it was a good investment. But now looking back, my vision is 2020, and I've been able to see that by purchasing this property in cash, it ended up costing me over $157,000 in income. And I'm going to show you guys all of the numbers of purchasing this property, selling the property, the return that I got from this property, and how had I gotten a loan on this property, I could have made an extra $157,000 over the course of the last 5 years. So with giving you that overview, now I'm going to show you exactly how this worked out and why you should always purchase your property with leverage using a loan rather than purchasing it with cash. Now, I'm going to be looking at my computer screen a lot because I want to make sure that I get all of these numbers down correctly for you so that this principle makes sense. And essentially the principle I'm going to talk about is that by using leverage, not only can you increase your cash on cash return, you can increase your overall return through principal paydown and appreciation if you end up using your money and leverage properly. So to start off, I want to give you the breakdown on why I purchased this property and what the numbers look like. I was able to take out my expenses, my management, my HOA fees, my taxes, my insurance, all of that, and with what I was collecting, which ended up being right around $750 on average over the 5 years, I was taking home in cash flow $337 every single month. That means every year I was cash flowing $4,048. That ended up paying me a 5.5% return on my $72,000. Now, this is the cap rate and the cash on cash return because I purchased the property in cash. So every year I was getting a 5.5% return on that money that I invested. So at the end of the day, I ended up making $20,240 over the course of 5 years in cash flow on this property that I had only purchased for $72,000. Now, $20,000 is pretty cool over 5 years, but a 5.5% return is actually pretty crappy. And that return was so low because I had a full $72,000 locked up in the property. Now, where things got a little more exciting is once I decided to sell the property, because I went from $73,000 that I purchased it to now being able to sell it for $120,000. Now, I know a lot of people are asking about closing costs and other stuff. My take home ended up being $120,000. That ended up meaning that just in appreciation over the course of 5 years, I made $47,000. I ended up making over a 64% return on my investment, and that's just appreciation. So when I put my appreciation and my cash flow together, I ended up making $67,200 on a $72,000 investment in just 5 years. That gave me a total return of 92% on my $72,000. Now, I know a lot of you are saying, Chandler, that's pretty dang good. For 5 years to get a 92% return on your money, you almost doubled it in 5 years. That's awesome. Why are you complaining? What's bad about this investment? And I would say you're right. That was an awesome return for a cash purchase. And I'm sure some of you will say, Chandler, you should have bought better than a 5.5% return. But overall, getting over a 90% return in 5 years is not that bad. However, it is total crap compared to what I would have gotten had I invested using a loan to purchase this property. And so I'm going to show you exactly what I would have made had it been on a loan. And turns out I would have made 3.25% what I made. So literally take that 92% return and multiply it by 3.25, and that's how much more money I would have made and how much larger of a return I would have gotten had I used leverage. So with that being said, let's jump into the leverage example. We're going to use the same property with the same purchase price at $73,000. What we're going to do different though is we're going to purchase it with a loan covering 75%, and we're only going to put 25% down. That means to purchase this property, I'm only going to use $18,250. I know a lot of you are saying, well, Chandler, now that's going to add a mortgage every single month that you have to pay. Turns out I'm going to use the same expenses that I had, the same management, insurance, all of that stuff we talked about earlier. I'm going to use the exact same, and I'm going to add in my mortgage every single month for this property. So with adding in that mortgage payment of $269 every single month, I'm no longer making $4,000 per year in cash flow. As a matter of fact, it's dropping all the way down to only $820 in cash flow per year. Now, I know a lot of you are losing your mind, but hold up, that return in cash flow ends up being right about the same. What I mean by this is before I was getting a 5.5% return on my money, but now I've dropped down to a 4.5% return on my money when it comes to what I'm cash flowing every single month. So I lost a percent return in cash flow. Now, granted, I lost $3,000 in cash flow on the actual return, but the percentage return is about the same because I only have $18,000 invested instead of $72,000 invested. That ends up meaning that my total cash flow for 5 years is only $4,100 when I purchase this property on a loan. But here's the deal. I also have principal pay down. So I'm now in a situation where every month when I'm paying that mortgage of $269, a portion of that is going into the property and just being saved in the property as if it was money that was put in with the down payment. So when you look at that, I'm getting $1,020 per year in principal paydown. That's an additional 5.6% return on my initial investment of $18,000. That means now with cash flow and principal paydown, I'm up to over a 10% return. As a matter of fact, an 11% return on my initial investment between cash flow and principal paydown. But here is where it gets absolutely crazy, and that is when we get to appreciation. Now, a lot of you are saying, Chandler, appreciation is going to be the exact same on this property, whether you buy it in cash or whether you don't. And I agree with you 100%. As a matter of fact, if you buy it in cash and my appreciation was $47,000, when I buy it in debt and a little bit of cash, my appreciation is still $47,000. That means that I'm getting a yearly appreciation of $9,400 every single year for that 5-year period. That ends up giving me a 51% return on that initial investment of $18,000. Just to break this all down for you so it makes sense, we're going to go back to the cash example. Now, in the cash example, I invested $72,000. With that investment, I was able to yearly make $13,448. That means I was getting an 18.42% return between my cash flow and my appreciation. That means over the course of 5 years, I had a 92% return. But on the screen, I want to leave it up here so you can remember I had $67,242 total in earnings, which gave me a 92% return over 5 years by purchasing this property in cash. So we're just going to leave this right up here. Now to jump over to the other example where I used debt. Now, because I used debt, these numbers are drastically different. Now, by using debt and only putting a 25% down payment and then putting together the combination of appreciation, my principal pay down, and my cash flow, every year I made $11,252 over the course of this 5 years. That means that every year I was getting a 61.6% return on my money compared to the 18% I was getting in cash. That means over the course of 5 years, I ended up making $56,262, which ends up being a 308% return on my money. So now you're looking at the comparison between getting a 92% return and a 308% return on your money. Now, I know a lot of you are saying, Chandler, well, what am I missing here? In one example, you made just over $67,000. And in the other example, you made just over $56,000. So obviously, I want to take the one where you're making more money. But here's the deal. For one of them, I only used 25% of the money. I only used $18,000. The other one, I used $72,000. So the reason that I told you at the beginning of this video that I ended up losing $157,000 is because at this time there were multiple condos just like this for sale. Had I used this money in 4 different properties, I would have made over $45,000 every single year over the course of 5 years. That would have given me a total earnings of over $225,000. So when you take the $67,000 return that I got by purchasing this property in cash and you subtract it from the $225,000 return that I could have had, that's where I got that I literally lost $157,000 that I could have earned had I used my money properly and invested by putting 25% down in 4 different properties instead of buying one property in cash. Now, looking at this example, it gets me super bummed out because obviously I made a great return on this condo, but had I used this money properly, had I understood what leverage was when I started investing, I would have been in a totally different situation. I would have been $157,000 richer. And what I would have done is 1031 exchange that money into more property so that I wouldn't have had to pay any tax on it. So with this, I can choose one of 2 directions to take. I can be super depressed and never buy a property again, or I can be pumped that I understand this principle and I can take the money I made from this cash purchase and divide it into multiple other purchases using leverage, which is exactly what I'm going to do. So with all of that being said, I beg of you, please, please, please don't use cash to purchase a property. Use leverage. Use as much leverage as you can as long as the numbers on that property are right. And please make sure to push this like button and go apply this principle, because I promise you, as you push the like button, subscribe to the channel, and don't buy properties in cash, I'm going to be able to help you to create a huge passive income for yourself. Thanks, guys. Have a great day.